Hello and welcome to the Monday Call. I'm your host, James Gregor, and alongside me I have Mark Brooks, Chief Investment Officer at NZ Funds. I'm excited to also introduce today's guest who is beaming in from New York, Chris Rhine. Chris, last time we met was about 2 years ago drinking coffee in London, and 2 years is a long time in financial markets. So great to have you back on the Monday Call to update us on events that you're seeing within your sector, and that is cryptocurrency. So, Chris, I'll let you elaborate a bit more on your background, but your current role is overseeing Galaxy Digital's liquid active crypto portfolio and emerging technology strategies. Another interesting part of your role, which I'm fascinated to hear more about, is you're responsible for the FTX liquidation mandate, as well as some of the market active ETFs sponsored by State Street. Also, another really interesting theme around take up of cryptocurrencies across institutions. Chris brings 20 years of experience to Galaxy with a career spanning shares, natural resources, and infrastructure, which are probably the three best sectors to get your teeth into prior to, I guess, the onset of digital assets and from about 2010. Chris, do you want to just talk about perhaps in a bit more detail, or first welcome and really appreciate you taking your evening to talk with us. NZ Funds have been associated and doing business with Galaxy Digital on behalf of our clients for some time now. And it would be great to give us a bit of an update on Galaxy itself and what you're doing within the business. And then, we've got a whole lot of questions given what's going on in markets at the moment and perhaps how those market ructions are affecting the digital asset space. So, yeah, let's get into it.
Okay. Well, thanks for having me too. It's great to talk to you guys again. Where to start? I think things are changing very quickly in crypto markets, but also in tech markets, particularly around what we're seeing in the AI space and just this insatiable kind of need for power and compute from many hyperscalers and other companies looking to utilize AI. That's played into kind of some of these changes that we've seen at Galaxy as well. From a crypto perspective, we have three major divisions: a sales and trading and advisory business, an asset management business, and a digital infrastructure business. And in the digital infrastructure business, we're working with institutions looking to tokenize different assets. It could be a stable coin. It could be a financial asset. We even tokenized a violin. We have a mining business, or I should say we had a mining business. We did just recently publicly announce that CoreWeave, which is one of the US hyperscalers, and they just IPO'd last week, they have agreed to lease out space at our data center in Texas. And we've entered into a 15-year lease to essentially host their GPUs, their NVIDIA GPUs, to be able to continue to evolve in this compute landscape. And the specs that they've given us, they want this data center to be able to be ready for next gen chips. And, that's a lot of infrastructure that goes into that. It's quite expensive. But it's a really exciting opportunity for Galaxy because it is a very high revenue, high profit, and predictable cash flow stream. And again, that's going to be over 15 years, and the build out will take a couple years to complete. Also in digital infrastructure, we have a very large validator business. So we're setting up validators across different smart contract blockchains from Ethereum to Solana. And then users are able to stake their assets with our validators and earn rewards. We have a DeFi team that's working on a lot of initiatives on helping other DeFi protocols get access to lending, get access to credit, and help provide liquidity for them. And we have a custody business as well. So Galaxy isn't just a financial player. We're also engaged very much in the technology. And I think that's one of the unique things about Galaxy relative to other types of companies in crypto, where they might just be doing one, or some of them, like a Coinbase, might be doing a couple as well.
Super interesting around the hosting of infrastructure. Mark and I were literally talking yesterday. when I heard comments about the new NVIDIA chips and
being water cooled and
yeah,
etc. Yeah.
And they compared it to, it's like if you got a new Apple iPhone, instead of just getting a new operating system and a new phone, you get a new Apple iPhone, house, car, and holiday house, and that's kind of the infrastructure you need for new Apple iPhone. And that's the sort of same with these new NVIDIA chips.
Yeah, and if you look at what we announced for CapEx to build out this data center, because we are definitely CoreWeave is very front-footed in terms of using the latest and greatest NVIDIA chips. It's going to cost us anywhere between 11 to maybe $12 million per megawatt of critical IT or IT that's running HPC compute. That's substantially higher than any of the co-location data centers you've seen, and even kind of the air-cooled infrastructure data centers. So, future-proofing these data centers is really important, and water cooling is going to continue to be a component of these chips on a go-forward basis, and really important to spec into the data centers today.
Cool. And I think a lot of people won't understand why CoreWeave would have chosen your site down there. Yeah, that which obviously is great access to power, right? Is it?
Yes. So
it's my understanding.
The site is approved for 800 megawatts of power. We have a substation on site already. A lot of the electrical infrastructure is there, and it's regulated by ERCOT, which is a very favorable regulator to be working with in terms of power. Texas is a great place for cheap power right now, partly because of the shale drilling that's taking place. There's a lot of natural gas, and there's also a lot of wind down there. So there's a lot of wind turbines that are generating quite a bit of energy as well. So the combination of kind of a cheaper source of energy, a lot of land, and then of course you have to have access to fiber near metropolitan areas. So being able to run fiber into major cities also important, and that's something that our data center was qualified to do as well.
I guess that's a good place to start, Chris. We wanted to talk about how the crypto market has been changing. One thing that's changing a lot as you discuss this is, you're transitioning that data center that was specifically, I guess, there for mining into other uses, because I guess it's a better way to use the infrastructure that you have there. That's just one tiny part, and that's great because it just shows the nimbleness of Galaxy. But the market as a whole, when we think about not inauguration, but when we saw Trump get voted in, for example, and around perhaps talk of lower regulations around crypto. But that's not the only thing that's changed. If you were to say over the past 12 months, let's pick a number, but it could be 12, 24, whatever it is. What are the biggest changes you've seen in the market, and in the sense of, I guess, uptake, institutions investing in it, the store of value sort of taking over the gold mantle? We're not quite there yet, obviously, but are there any themes that you think about that are like, wow, this has been a big change over the last year? I know, and it's something worth keeping in mind.
Yeah, I think if you go back, just the old administration and the old regulators' approval of the Bitcoin ETF just over 12 months ago, I think that was a huge game changer. I think the first application to create a Bitcoin ETF went in sometime around 2013. And it took, over 10 years for that to finally occur. And, it was very difficult given that the prior administration and regulators took a very hostile stance towards crypto. And after you had the Bitcoin ETFs, they even followed suit with the Ethereum ETF as well. So those really helped to open the door and kind of make people aware that this asset isn't going away. And seeing other large financial institutions really put support behind this, put support behind crypto, and say that, yes, there is an actual purpose for these assets, and there might be a place in your portfolio as well. I think what we saw last year from a more institutional standpoint and an access for institutions to actually invest in these coins was phenomenal. I think you touched, on the next thing, and really it is the current administration's stance on crypto. And this is going to really, and it's happening very quickly. It's flowing into the legislative side and it's flowing into the regulatory side as well. All of the regulators have already started working with entities in the crypto space, as well as traditional financial institutions, on making sure that proper regulations are established. On the legislative side, you have a number of working groups right now putting together studies on, crypto, and a lot of the output of these studies are going to be used in the stablecoin bill that we think will likely be passed before the summer recess in August, and then importantly, the market structure bill. And once you have these two bills that are passed, it's really going to create the regulatory and legal clarity that large regulated financial institutions need to be able not only to offer crypto to their clients, but to start building applications on top of decentralized blockchains. And that is what I think is going to end up being the story for 2026. And it's going to be really, really exciting to see finally use cases in the United States. And if I ask, if I told you how many people ask me, why don't I see use cases for crypto? It's because the prior administration demonized crypto and nobody would touch it. But now that that is completely changing, there's a lot of different software developers and even incumbent banks that are looking at opportunities on, tokenized assets, at payment platforms, and other types of settlement options you'll have on a 24/7 blockchain as opposed to current banking hours.
So Chris, does that suggest in a way that's going to be hard for people to see, though, that's going to happen in terms of the plumbing is going to be the real use case to start with, sort of the financial plumbing?
I would love it to be like that, because at the end of the day, nobody should really care if it's using, a crypto blockchain or if it's using a network that is owned by a single entity. The beauty of the using a decentralized blockchain is the fact that there are no business hours and you can send things much quicker, and the cost to do so becomes much lower as well. So right now, even, if I would go to the bank, to JP Morgan, for instance, and try to convert dollar into euro, I'd probably be charged around 600 basis points of fee. But if you can do this on the blockchain very easily with the use of euro stablecoins and dollar stablecoins, you could do that instantaneously at a much cheaper rate than what a traditional bank will do. And I think these incumbent banks are worried about how crypto will impact their net interest income, because there's a lot of areas that they have generated substantial amounts of money. And part of that is just not paying deposit rates or not paying interest on deposits. And stablecoins are really going to potentially threaten that as well. And they might actually have to start paying interest on some of those deposits to be more competitive with stablecoins that we think in the future will start returning interest back to the actual stablecoin owner.
I've just moved back to New Zealand from the UK, and it just grates me those charges, banking charges. Even if you find, you can find these online ones that are much cheaper than your mainstream bank, but you're still charging a prohibitive amount for doing not much. I think it's game changer. Does that also mean, therefore, you see M&A in the sector as the companies behind these stable coins, absorbed by banks essentially to try and ward that off, and consolidation around the crypto sector as these things become more mainstream?
I think a lot of banks are looking at launching their own stable coins.
Yep.
I don't know what that means for M&A. Like right now, the two major stable coins that are out there would be Tether and Circle's USDC. Those are the primary stable coins that are used across the crypto ecosystem, but they don't have to be the only ones. And given that, the growth of stable coins more recently has been very, very significant, a lot of other parties are looking at this. But stable coins, what we're seeing is that there's a little bit of a network effect to it, that the more people that use it, the more places you can use it. I do think that the large banks will enter the space. And from just the standpoint of a known entity or the safety aspect of having a stablecoin issued by JP Morgan, it's a little bit different than the safety aspect of a stablecoin being issued by Tether. We know that JP Morgan is regulated by the SEC. It's a public company. It's a little bit different for a company like Tether. So the banks are looking at the stablecoin market as something that they could really enter into and start taking share. And then they would use their stable coin, of course, for their own internal transfers, or maybe even bank to bank transfers, where if Bank of America has a stable coin and Chase has a stable coin, they're always one to one, exchangeable. So there's going to be a lot of changes, and the fact that this is happening should hopefully be good for consumers, not just from a speed to settlement, but also from a cost standpoint.
It might, you know, I guess, increase competition around that, but also you're starting to see stable coins be a big player in just financial markets. I think I read, and correct me if I'm wrong, but Tether's the sixth largest buyer of US treasuries out of any country, and it's a coin rather than a country, which I just think is fascinating.
So right now, I think the stablecoin market is about $140 billion, and the stablecoin issuers will put that capital into short-term T-bills, essentially as collateral that will back the stablecoin. So, as the stablecoin growth continues and you continue to see more stablecoins issued into the ecosystem, you're going to see more of those T-bills being bought as kind of the collateral, the reserve that backs those stablecoins. So they have been huge buyers of U.S. paper, and I think that's one of the reasons that this administration really wants to see that continue to stay in the U.S. Because we have quite a big deficit and continually need to have that funding.
Yeah, it's something that we can talk about later. Don't worry, you're funding it now with the with the tariffs.
And Circle's about to. Did I see something they're planning to list, or they just announced an IPO? So you sort of another step in that sort of change in environment, right?
Yeah, Circle tried to go public through a SPAC in the prior administration and prior regulators, and was pretty much shut down. They did just publicly file to go public and IPO. So we just saw the prospectus this week, and we've been looking through it. And this will be one of the first crypto companies to get an IPO in the U.S. markets in quite some time.
So when we think about these policy landscape changes, Chris, and regulation is a really good thing because it means more take up. People can be nervous by it, but actually it's positive, albeit perhaps older administrations created more uncertainty with it. But if you're a net positive administration on crypto and then you bring in regulation, then actually and legislation, that's a good thing. What has it been doing around pricing? So going from the sort of more vanilla ones around Bitcoin and Ethereum, but then through some of the more, I guess, esoteric ones and NFTs and those sorts of things. I think last time we spoke, and we spoke with clients around this with you, it was a tough market, if I remember. It was a few years ago, they were calling it the crypto winter. There was a lot of negativity. We've had this regulatory progress, which is positive, a new administration. What's happening with pricing now is, and I guess most of us that follow it know the prices have gone up, but are we seeing more stability, less volatility, more normalization of an asset class?
It's kind of interesting when you look at the crypto markets excluding Bitcoin, because it's almost like a tale of two cities. Bitcoin continues to be a significant outperformer in the crypto ecosystem. And part of that is, you have new institutions, new buyers, and you have more money coming into the Bitcoin, ecosystem, and it's a fixed supply. So price has been holding up quite well. On the other hand, you then have what I would like to think of as kind of the smart contract and decentralized blockchain ecosystem. And that could be your layer ones, your layer twos, your oracles, and all of the other different types of DeFi protocols and utility protocols. What we've seen there hasn't been nearly as pretty as what we've seen in Bitcoin. And Ethereum, even this year, has been just a significant underperformer, probably down somewhere in the realm of 40% or so. Many of the other smaller layer ones are down even more. You're seeing declines of 50, 60%. And I think crypto is interesting from the standpoint that when you look at the way that traditional asset classes were built and investors came in, think of like the mortgage-backed security market. The first investors in those products tend to be institutional investors, smart investors. Crypto is interesting in that the first investors in crypto was retail. It was, individuals who figured out that, hey, there's this way to buy these interesting tokens and they're going up in price. And then more and more retail bought it, and more retail heard of their friends and their relatives getting rich on some meme coin or NFT or some other altcoin. And we had this flood of capital into that ecosystem. That's kind of what led to the crypto winter that you're mentioning in 22 that kind of took forever. We did have a bit of a rally at the end of 23 and into 24, but really since the first quarter of 2024, I would say that a lot of these altcoins have just been losing a lot of steam. I think the reason behind that is driven by a couple different factors. One is that the venture capitalist funds that were taking, stakes in different types of companies were essentially taking tokens, and they would be locked tokens. So they would provide funding to these protocols, these teams, and they would get tokens that would be distributed at set times in the future. Initially, retail thought, well, hey, whenever we see a lot of smart investors buy something, we should buy it too. And that's what, if you see smart hedge funds buying equities, you'll want to buy that equity. But what then happens is, because these are illiquid investors, the second that they can turn that into cash and return money to their investors, they will liquidate that in the market. And what we saw is you were getting these token launches that had not much float and a lot of not much liquidity and a lot of upside convexity when everybody's trying to buy it. But then it can fall very quickly too whenever you start seeing a lot of sellers come to the market and essentially providing that liquidity. So part of it is market structure, as it has to do with VC and retail. I think the second big thing is retail. They are typically momentum type investors. And right now in the altcoin market, there's just no momentum. A lot of capital came out to try and chase some of the meme coins. A lot of capital has come out more recently. We've seen even like the AI tech market. There's been more selling in China of crypto, and we've seen that correspond to an uptick in Chinese equity markets. So I don't think institutions really are keen on investing in that esoteric part of the market. And the way that we're looking at the token market is more akin to who are going to be the key winners, what protocols will be the key winners, what provides real utility, real infrastructure, has a real team, and a real growth plan. And honestly, that essentially wipes out 99.999% of all of the tokens out there. And you can focus on just a key set of what I would consider core protocols. Those are the protocols that we will see institutions using. We'll see Ethereum being used by financial institutions for tokenization. We'll see it being used with a DeFi, decentralized finance and centralized finance kind of merging together. We'll see Oracle systems being used to take off-chain data and bring it on-chain. We'll see layer twos being used to essentially cut the cost of executing on the Ethereum blockchain. But you're not going to see a lot of institutions use some of these other L1s that really don't have much purpose out there. There's a lot of what I would say copycat protocols that are out there, and many of them are unnecessary. There's a lot of tokens that have no purpose whatsoever. They don't do anything. It was just essentially a way to invest in the momentum of the protocol, but you don't get anything for it, and you don't need it to execute a transaction at all. So I think a lot of that froth is being pushed out of the market, and where we're going to see a lot more kind of opportunity is going to be in a core set of what I would think of as blue chip protocols that actually will be needed to utilize blockchain infrastructure.
In
Sorry, that
simple
was very
language,
long-winded.
no, I think that's fascinating, because I think it sort of history doesn't repeat, but it rhymes, and it feels similar to the tech boom and bust, and then boom again, where everybody with a .com in the tech boom went up. Then actually, there's a lot of companies that had a .com after their name but didn't do anything.
Well, you can kind of call it's in what is going to be adopted, right?
Yeah,
it is that tech adoption profile, and the winners will definitely win, and there's a lot of others.
Can you
use
talk
that
about
tech bubble analogy quite often?
Sorry, I interrupted you. I think it's a really good one, and that's why when you see the winters, it's sort of exciting, because it is a flush out. I think many of us know Bitcoin, but can you perhaps talk about some of the other protocols that you're looking at? Well, certainly this isn't a podcast that are setting off trade ideas, but in terms of just the usage of them is what I mean. Like what are the protocols, and why are they being used, and why are they interesting? Like, what are the use cases? Because Bitcoin is store of value. I see it like gold, but what are the other things doing that? Are they helping with payments? Those sorts of things.
Yeah. So why don't we focus on Ethereum, because I think Ethereum is going to be the main blockchain that a lot of financial institutions end up using in the US. And essentially, the feedback that I've heard is it's been around for a while. It has gotten much more efficient, much cheaper, and the entity that runs it is an independent entity, the Ethereum Foundation. It has a lot of reliability in terms of the network uptime, and it differs from the other layer ones in a number of different ways that we don't have to go into. But what I've heard is if every banking institution is building, software on top of Ethereum, and I'm the one bank that doesn't, and it doesn't work, everyone's going to be like, well, why the heck would you do that? So a little bit of it is risk management from reputation, because you're just going to do what everyone else does, and then you'll never get in trouble because everybody gets in trouble.
Yeah.
So actually, one of the interesting things I saw yesterday, so the Depository Trust Company, DTCC, announced that they have created a way to do 24/7 automated collateral on a blockchain. And they're using essentially an kind of like an application layer that will utilize the Ethereum network. And one of the other protocols that they'll be using is Chainlink. Chainlink is an Oracle protocol that will take data from the outside world and bring that on chain in a very trustless manner. So if, the Ethereum blockchain doesn't know what the price of Apple is, at any point in time, you would need to take that price and put it into the blockchain for some other application to be able to utilize it. Oracles, I think, are going to be very important in this whole concept of tokenization of private credit, of more stable coins. That is a tokenization, but where you might have assets trading on one exchange that isn't crypto related, and we need to bring that pricing data into a blockchain. Other areas that we think are interesting are kind of the DeFi lending space. One of the biggest lending protocols out there is Aave. Aave is a very, very successful protocol where if I'm looking to generate a return on assets, I can put up capital that somebody could borrow. And I may require them to post collateral that is 130 or 150% of the amount they borrow. If why would they want to do that? Because they think maybe Bitcoin's the collateral. They think the price of it's going to keep going up and they don't want to sell it. If the price goes up, then they could reduce the amount of Bitcoin that's held as collateral there, or, they could just eventually pay back the loan and take all of the collateral. However, if the price of Bitcoin goes down, and there would potentially be a level where if the collateral value dropped too far, it would be worth less than the loan they took out, the smart contracts built in will automatically liquidate all of that collateral and pay off the loan to the entity that was the lender immediately. And we've seen this time and time again work completely seamlessly. And in times of stress, like when FTX was occurring, other types of high volatility moments, some of the exchanges, they freeze up, and people can't log in, they can't make trades, they can't post more collateral to try and even prevent the centralized exchange from liquidating them. Aave didn't have one issue in any of those instances. And it's totally a programmatic, lending based, decentralized finance tool. And I honestly think that with the regulatory approach that will be brought in, we're going to see a little bit of of an interaction between centralized finance and decentralized finance. And maybe you'll even see some of the centralized entities providing liquidity onto these platforms, providing capital that people can borrow against. When you have more, as you guys know, as you have more depositors that are lending capital out, that could potentially drive lending rates down, making it more efficient for users or cheaper for users to take out credit.
Yeah, it's such a interesting part of the market around using this as collateral and what it could do for small lenders and small borrowers, sorry, and businesses and things where it's perhaps much easier to gain credit rather than going through that clunky process of going to a bank and getting credit that way.
Yeah, absolutely. I agree. And I think that's kind of what DTC has realized, is that if you can automate this process of collateral, and you can actually use this on a 24/7 basis, just like they're doing on crypto, you can improve the whole system that's currently in place, which is still very kludgy and clunky.
Perhaps we should transition a bit to current regime, if you're ready to.
Yeah, or the only question I was probably going to ask, just in terms of adoption, is actually going back to Bitcoin and sort of where do you think adoption's the wrong word for Bitcoin, but where are we in terms of that institutional adoption? Is it sort of, to use a baseball analogy, are we still sort of second innings, or is it actually fairly deep into the game?
We're not deep into the game at all. We're starting to see more institutions, and I think the visibility that we see in the kind of the quarterly filings with the ETF holders, we're seeing more and more institutions that are starting to invest in Bitcoin via some of these ETFs. We've seen certain investment advisors pop up, but they tend to be kind of the smaller independent investment advisors that can move a bit quickly. The larger platforms are still in the process of approving, some of these spot ETFs to be used with their wealth platform. But some of the larger entities like endowments, we haven't seen a ton of pickup in endowments on some of these ETF filings. We've heard a lot about different states talking about Bitcoin strategic reserve and Bitcoin investments. Those are still kind of working their way through some of their own, state by state legislators. So I honestly, I think we're still very, very early innings in terms of adoption of Bitcoin. And the great thing about Bitcoin is it's kind of like it's the way that people start getting curious, crypto curious. And it tends to be a way for people to start doing more education on what crypto really is and why it's great to have a public ledger that you can track every transaction, and how you can't do that with fiat currency. You can't do that with other types of transactions. And, it's going to be something where people just take time to kind of get this older viewpoint of, hey, this stuff is only used by bad people and, people doing nefarious business, to this technology actually has a real purpose and it can improve the current way that we're doing things.
As someone that works in it every day, Chris, does that frustrate you? I mean, we're still talking about that 5 years later. I mean, come on. It's amazing how slow some of these institutions are in thinking about adoption. How, one, it's a great asset to diversify a portfolio, even if it's a small part of a portfolio, all the way to being curious around it as a use case, and therefore as an interesting investment. And we're happy to invest in some companies with little to no analysis. I think crypto is one of the most analyzed asset classes out there. yet there's still some bogeyman sort of mentality around it.
I think
Talking to the
a lot of
converted, obviously.
institutions, yeah, where they run into kind of a lot of issues is just the volatility structure of crypto. And part of that is the nature of retail and how they trade, but also some of the, exchanges that retail can use that can allow them to get massive amounts of leverage, which, if you're employing massive amounts of leverage, can drive sharp moves in the price of these assets, particularly when liquidity is a bit lower. And because of the way that these positions are put on, they will get automatically liquidated in the event that the price moves in the wrong direction. And that creates a bit of a cascading effect. And that's one of the reasons why sometimes crypto has these really strong drawdowns or even a really strong move up, because you either have a lot of long positions getting liquidated or a lot of short positions getting liquidated, which continue to just push the price up. It's kind of like when dealers in options are getting squeezed, when the price of the equity keeps moving in one direction, and they either have to keep buying or selling, whatever the underlying instrument is, to hedge themselves out from a continued move in that asset. So that's what we're seeing on the retail side. And with a 50 to a 75 vol asset like Bitcoin or other, of cryptocurrencies, there's no reason to employ 50 or 100 times leverage. It's mind boggling that these levels of leverage are even available for retail, because you can destroy your capital base in a matter of seconds.
Yep. I think one thing that I've found useful with clients is just pointing out, yes, Bitcoin's had a 50 vol, but actually so has NVIDIA. And especially given recent experience, there is a lot of volatility in single stocks, even really big ones. And people often just don't realize that either.
That's true. And, for investors that are able to be a little bit more sophisticated, when you do have a high vol asset like that, and now you have liquid ETFs, you can create streams of income by writing, out of the money call options, and you can still afford for 35% capital appreciation, but generate income via the premiums of those options. And in many cases, on an asset like that with that volatility, there are entities that can generate pretty high single digit, low double digit type of returns, and still price those strikes far enough out of the money where, even in the event of a 20% move in the price of Bitcoin over a month or two, they wouldn't get called away.
And with those 50% vol assets like NVIDIA, I don't think many people are leveraging them 10 times. Or perhaps some people are, I don't know. I wanted to, it would be remiss of us, Chris, not to talk about the events that are happening at the moment in just general financial markets and tariffs, and the announcement by the US government. So you're a lot closer to it than us, sort of geographically, and affected by it, because although it's tariffs on places like New Zealand, you're the consumer that has to pay for it. But I think most people now probably hopefully understand that in America. But when we think about crypto in that space, is this actually kind of a good thing in a way, because that decentralized model and government intervention is part of the attraction of cryptocurrencies, is it doesn't have that sort of attachment to government necessarily?
Yeah, it's actually something that my team was debating a lot of. And when I think back to what happened during COVID, or even what happened in the regional banking crisis in the US, the knee-jerk reaction is everything sells off. Risk sells off, Bitcoin sells off. But what's tended to happen after that is people realize that something is wrong with our financial system, or something might potentially break. And the solution has been, let's just plow a ton of money into the economy. And, what we've seen with Bitcoin is it's responded very well when central banks start easing and potentially putting more and more cash into the ecosystem. What they're doing is devaluing money, and Bitcoin can't do that. It is a fixed quantity. It will not have more than 21 million tokens, and it should be a hedge against this type of money printing that we're seeing, not just in the US, but we've seen it across a number of different locations. The second thing that we've seen, and I was just down in Argentina areas where you have hyperinflation or very high levels of inflation, dollars are scarce and they love getting dollars. So, being able to park capital in Bitcoin, which is a dollar-based asset, instead of in your local currency, is a huge way to preserve wealth that doesn't require you to buy hard assets or real estate. So, you know, part of it is irresponsible governments that are seeing hyperinflation, which causes deflation of their currency. And then the other part of it is, this is an asset that is seemingly protecting against a Federal Reserve or, government policy, which creates chaos that leads to a substantial amount of money being created in the ecosystem.
And do you think, the way it's trading at the moment, that those sorts of things are on people's mind, I guess? Hence, it's been relatively stable, given its volatility.
I think it just takes a little bit for the market to kind of clear itself. We tend to see fundamentals go out the door when people just need to reduce beta, reduce risk, and raise cash. It doesn't matter if a company has great earnings and great valuation; it may go down the same amount or even more than a company that's really expensive. It's these type of sell-offs can be indiscriminatory. I do think that when I think about what happens if these tariffs stay in place, the world is going to be a much worse place, and I think we're going to see a significant slowdown in growth across the world. And I think then what typically happens will be that central banks will have to step in and prop up growth. And the way that a central banker might think about inflation, it might be a little bit nuanced. So inflation that's driven by a mismatch of supply and demand. And this is what we saw after the COVID crisis, where we just didn't have enough supply to keep up with demand. That's real inflation. That's not something where there was a short-term event that maybe caused a plant to go down, but that comes back. What we're seeing with tariffs is this is forced inflation. This is generated inflation. It's not due to supply and demand. It's due to policy. So it's a different source of inflation than not having enough of a good. It's just now it costs a lot more to bring that good in. So what we'll see is a very quick pricing response as a result of this, but will it have a lot of duration after that? Or if it causes demand for those goods to go down, do we have excess supply? And that will really kind of put pressure on margins across different companies. Again, with Bitcoin, you don't have to worry about margins. But when we see profitability at companies coming down, when we see demand for their products coming down, we see stock prices coming down, they start laying off employees, the unemployment rate goes up, growth is slowing. That's when I think you'll see central banks step in and just start pushing money into the ecosystem. And I think that's really going to be when people realize that Bitcoin is a great hedge against that.
And one thing that we didn't see sort of, I suppose, last year and during 22 was the ETF demand for gold. Do you sort of, and that's been coming back lately, and especially as interest rates come down, do you see that as a bit of do you see a trade-off between Bitcoin purchase and physical gold ETF purchases, or do you think they sort of run in lockstep these days?
Yeah, I think we've been seeing central banks accumulating physical gold. We've, more recently saw China was a big consumer of gold as well. And now we've started to see the ETFs start to accumulate or see more flows into gold. So gold has definitely been an asset that is seeing a lot of attention. And there's a company out here called Costco, and they actually were selling 1 ounce gold bars, and they couldn't keep them in stock. All the retail users were trying to buy these 1 ounce gold bars. And I'm ashamed to say it, but I have one for each of my daughters in a safe. And we talk about what a physical asset is and why that's different than a stock, but how the price can still appreciate. But, I think gold has definitely been perking up because of its status as a safety asset. It tends to be a good diversifier in portfolios. It hasn't, again, it doesn't have an income stream like equities. And, when you have a commodity like that, it's supply and demand. The supply of gold has been growing, but the demand for gold has been growing quite a bit as well. So, has it moved too much? I'm not sure. Could it pull back a little bit? Maybe. But if the overarching geopolitical tension that we see today doesn't improve, I think that assets like that could be in demand because previously maybe they weren't so in demand and people just don't have enough of that exposure in their portfolios today.
At the start of this call, Chris, we were talking about some of the changes that you're seeing around payments and those sorts of things. So as we start to wrap this call up, there's just so many things going through my mind about what I want to talk about more, but perhaps we can think about 2025. So 2026, I think you started to talk about some of these adoptions really taking place. What about over the next sort of, how long have we got left in the year? 9 months. What are some sort of waypoints and things we should look out for, and announcements we should track to I guess set us up for that 2026 year where we think some of these things are really going to take hold?
Yeah, there's a long list of things. One, I think you're going to see a lot more crypto-related companies work to go public on the U.S. exchanges. I think that's going to continue to mainstream crypto a little bit. Two, I've never seen such a difference in sentiment from institutions and retail in terms of crypto. But I think that has to do with investment time horizons. Retail still is very much, what can I make the most money in the shortest amount of time? Institutions are looking at this as a shift in technology, a shift in opportunity, and a real asset class that has a purpose. And they think about things over 10 and 20 years, not 10 days. On the actual application side, we're seeing a ton of activity in the stable coins. A lot of entities are really, really looking at how they can utilize stable coins, how they can issue stable coins. And once we get the stablecoin bill, one of the features of stablecoins that's missing is that interest return from that collateral back to the actual owner. So you could start to see stablecoins become yield-bearing type of assets, whereas right now all of that yield goes to the issuer. Other things we're seeing is just a ton of traditional financial companies pushing further and further into the crypto ecosystem. We're seeing it with the traditional custodians looking to get into the custody aspect of crypto. We're seeing, different types of trading firms looking to get engaged with crypto. And, we're seeing, back to what I said earlier, a lot of the traditional banks thinking about how they can, upgrade their payment rails to utilize blockchains. But a lot of that will be, waiting on just this change in legislation and regulation. But a lot of that background work is already taking place so that these banks aren't behind whenever it becomes available to go public. And they don't want their competitors essentially to run away with the business because they forgot to do the homework earlier.
Mike, do you have any further questions?
I think that's all from me. Yeah, it's been great, Chris. I really enjoyed that, and as always, learned quite a lot.
Yes, same with me, Chris. It's just when you think you've got your head around the sector, it just shows what can happen over a short period of time. And it's just like I think it's a reminder everything you've talked. Exactly, and I was about to say exactly that. It's a good reminder that some of these tech companies that are out now don't even think about volatility of markets from yesteryear. And I think in times like this, when there is volatility in general markets, and then you see what's going on inside a sector or an asset class like crypto, it's kind of irrelevant because there's so much good stuff happening that you just have to choose wisely, do your analysis, go through your process, and it's a long-term game and things will come right.
Definitely.
Well, thanks very much, and enjoy the rest of your evening, and look forward to speaking again soon. Thanks so much.
Thanks, Chris.
Great. Thanks, guys. Take care.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.